Hello and welcome to the Week in Markets. My name is Paul Durrans, Investment Director, and I'm joined by Portfolio Manager Matt Henderson. Now, it's been an extremely busy week for markets in terms of central bank meetings. We've had the Bank of England, the Bank of Japan and the Federal Reserve all meet this week, and we're going to discuss each of them in turn. So perhaps starting with the Bank of Japan, they kick things off this week. Coming into the week, there were expectations that they would change their negative interest rate policy. They've had interest rates at 0.1% for the last 8 years. I suppose, Matt, can you tell us the details of what came out?
Yeah, thanks, Paul. So, as you mentioned, Bank of Japan expected to change policy, and that's what they delivered on the day. So, interest rates had been negative 0.1%. They've decided to increase that. Right. So, they're now operating within a range of 0 to 0.1%.
And that's because they've changed that. We've had stronger wage growth come through. We've had they've got more confidence that inflation will be more sustainably at 2%. Is that right?
Yeah, so in previous Bank of Japan meetings, they've talked around the idea of inflation sustainably meeting their 2% target. There'd been a little bit of questioning of whether that was actually the case, but as you've mentioned, what we've seen in recent times is union labour agreements starting to come through on the wage front. So that's actually provided them the confidence that if these pay rises do come through, that wage inflation can lead into price inflation. So that's where they're seeing the element of sustainability coming through.
And that's because people are earning more, so spending more, and that just helps generate more economic growth, more inflation, and as you say, get to that 2% inflation target more sustainably, and that's allowing them to move on interest rates. I suppose if we think about the markets themselves, we saw Japanese equities continue to push higher after reaching all-time highs earlier in February, and we saw more weakness in the yen against the dollar. So if we turn now closer to home, thinking about the UK, the path of inflation in the UK has been on a downward trajectory. I suppose, what did we learn from the inflation data this week?
Yeah, so data came in, so we got headline and core inflation like we usually do. Headline came in lower than last time. We're now at 3.4%, as did core. That came in lower than last time, so we're at 4.5%. And all of the measures that got published with that inflation report have come in below the market consensus. So I guess the theme that we've spoke about with the UK and also Europe of disinflation coming through, i.e. the rate of inflation moving lower, that continues to persist.
Yeah, I suppose it's the Bank of England has still been a little bit cautious in terms of their tone about cutting interest rates. If we think about inflation, it is on a downward trajectory. It's at 3.4%, it's still above their 2% target. But when we look at the individual components, services inflation, that's still quite elevated. And also if we think about April, that's where you get a number of wage increases coming through. The national living wage is expected to increase 10%. So it's still a little bit early days in terms of interest rate cuts. But in terms of what they discussed about interest rates, what they set, what were they?
Yeah, so Bank of England meeting was on Thursday this week. They've decided not to change interest rates. However, what we have seen develop is how the members of that committee voted and how those have changed. So last meeting, we saw 2 members wanting to hike, 1 member wanting to cut, and the remaining 6 looking to hold interest rates. How that's actually developed this time round is that those who wanted to hike have not voted that way. So we've now got 8 members wanting to hold interest rates, 1 member looking to cut.
So I suppose it's a slight nod in the direction that we're closer to interest rate cuts this year, given those 2 members that wanted to increase interest rates have come into the consensus of no change for now. I suppose it's, if we think about how the market reacted, we saw sterling weaken 1% against the dollar over the last 24 hours. That's been a slight positive for the FTSE 100. That was up just under 2%. FTSE 250 up over 1%. So just a bit of confidence that interest rates are going to come down this year. Still a little bit uncertain on the inflation direction, but all being good expectations are for inflation to drop to 2% by the spring. and markets are taking that well.
And inflation dropping to 2% by the spring's the Bank of England's own forecast. So
Exactly.
they've got the confidence as well that it's going to come down and allow them to reduce interest rates from where we currently are.
Spot on. And finally, I suppose, thinking about the US central bank, the biggest in the world, and I suppose expectations in the market in terms of interest rates this year has been quite volatile in terms of starting the year, 6 interest rate cuts expected. That's moved back to 3, back in line with the Federal Reserve. Inflation data has been a little bit surprising to the upside. What did we learn from the Federal Reserve this week?
Yeah, so Fed, a bit like the Bank of England, left interest rates unchanged, but what we got alongside that interest rate decision was their refreshed economic assumptions. So they break it down into 3 main components for us to think about. Labour markets, inflation, and GDP. If we start with labour markets first, they were, roughly unchanged. The forecasts very much similar to what they had last time. So where the 2 main changes we've seen are within inflation component and also the GDP component. So for this year, 2024, the Fed are expecting that inflation is going to be about 0.2% higher, so that takes them to 2.6%. But the main change that we've actually seen is within the GDP component. And what we saw is that this year they're expecting GDP to be about 0.7% stronger, so quite a material revision higher. But they've also moved higher the 2025 and 2026 expectation. I guess also what's interesting for markets is that they provide guidance on where they see interest rates going into the future. They've actually left those unchanged for 2024 and 2025.
Yeah, so I think they've left them unchanged because whilst the inflation has been trending down and more recent prints has been slightly to the upside, it's that trend that's important to them, and that still gives them confidence that they can bring interest rates lower. But I suppose if we think about how equity markets have responded, it's pretty good. If you think growth is slightly stronger than initially thought, and that's sustainably, if we think about the forecast being moved up for the next 3 years, unemployment remaining firm, inflation coming down, but also cutting interest rates. So equity markets have been up this week. Bond yields have fallen, which is positive as well. So good for 60-40 portfolios in general.
Absolutely.
That's excellent. Thanks, Matt, and thank you for watching. That's all from us today, and we'll see you next week.